Hi, welcome. Thanks for watching and I appreciate you being here. Today's video is about tax loss harvesting. I'm going to talk about how I harvested losses this year to lower my future tax bill, all while avoiding wash sales. In this video, I'm going to talk about what tax loss harvesting is and how it works, some strategies that you can employ, some of the common strategies that people employ. I'm also going to define what a wash sale is, and then I'm going to go over how I did it in my own account. I'm going to provide a brief overview of the two funds that I use, and then I'm going to do some performance comparisons. Make sure that you stick to the end for a couple of funds that can be used for tax loss harvesting purposes without violating the wash sale rule. And as usual, towards the end, I'm going to offer some resources if you want to take the time to look into the stuff and do your own research if you're interested. But first, here's a little bit about me. Hi, welcome to my channel and I'm glad to have you here. Here's a little bit about my family. Our household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. My husband and I both went to graduate school, but we no longer have student loan debt, fortunately. I work in banking and he works in aviation. I handle all of the family's finances, and I love my role as the self-appointed CFO. I love talking about all things money, making money, saving money, investing money, and optimizing my portfolio and my finances in general. I look forward to taking you on a wealth building journey with us. I hope you enjoyed the videos and the channel as a whole, and I look forward to getting to know you. I am very open, so feel free to send me messages at any time or starting conversations in the comment section below. Before we get started, I want to give you a reminder that this is not intended to be financial or tax advice. I am sharing what works for me, but it may not work for you because I don't know your specific investment situation or your specific tax situation. Also, a quick refresher on my family and or tax profile. I am married and we are a dual income household on W-2. That means we work for somebody else and we get paychecks. We have one minor child who is our dependent, and all strategies that we employ reflect these characteristics. All right, so what is tax loss harvesting? Tax loss harvesting is when you use realized investment losses to offset your income. The IRS allows you to lower your taxable income by offsetting it with losses in two different ways. The first one is that you can use all of your losses to offset investment income. Another way you can do this is you can use up to $3,000 in losses to offset regular income. Any excess above the $3,000, they roll over indefinitely every year until you deplete it. That means if you had $9,000 in losses, you can roll them over the course of 3 years, $3,000 each year, to offset your regular income. In the simplest terms, the mechanics of tax loss harvesting involve selling losing investments to lock in those losses, and then you turn around and you buy some other investment. And there are different strategies that you can employ. Before I go into the different strategies that can be employed, ask yourself this: does tax loss harvesting work all the time? If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. Not necessarily. If you sell a stock at a loss and you buy a stock that is already up, you are buying high, selling low, and buying high again. It also doesn't fully work if you buy something completely different. For example, if you sell JP Morgan at a loss and you turn around and you buy Google, I guess you tax loss harvested. It works on the tax piece, but it doesn't necessarily work for your investment objectives. You're selling something in the financial sector and you're buying something in the tech sector. You're completely changing your asset allocation. And that's a good segue into the first strategy that we are going to discuss. The first thing that you need to remember is that you should not let the tax tail wag the investment dog. So make a plan for doing this that does not necessarily interfere with your goals for your investment portfolio. Also, remember that it works in taxable accounts, not in tax advantage accounts, because buying and selling in tax advantage accounts are not taxable events. Ideally, you want to make sure that you keep your allocation either the same or at least very close to the same. Otherwise, you're doing more than maximizing your tax savings. You're potentially changing your entire portfolio allocation and your investment strategy. Yes, I am saying the same thing 3 times in 3 different ways because it does matter. Don't let taxes drive your investment decisions. There is no predetermined determined time other than whenever you see losses, because you don't know if it will go lower, you don't know when the bottom is, or you don't know if it will go higher. The reason why I'm saying that is because there's often times when we talk about tax season. Whenever December rolls around, we start talking about tax season because W-2s come out at the end of January, 1099s come out sometime in February. We start getting ready for tax season. A taxable event counts for any activity that happens between January 1st and December 31st. You don't have to wait until the end of the year. In my case, it's only May, but I saw an opportunity and I decided to take it. Is it the right time? We don't know. We won't know until January 1st because we don't know what the market is going to do the rest of the year. But I made a decision and I moved forward. You also want to make sure that you move quickly because you don't want to sit on the cash too long and miss a run up. That means missing on gains and putting yourself in a position where you have to buy higher. Some people will select specific lots that have losses. If you've been investing for a long time, you might have some of your purchases that are still in the green because you got them at a very low cost basis a long time ago. You might only need to sell the recent stuff that you bought at a higher price. And last but certainly not least, one of the most, if not the most important strategy is to make sure that you avoid a wash sale. What is a wash sale? A wash sale is defined as selling or trading securities at a loss within 30 days of buying or selling a substantially identical security. Substantially identical. That is where I'm putting the emphasis. That is where you need to be very, very careful. For example, if you bought XYZ Corp for $100 and it drops to $75, you decide to sell it at a $25 loss and you don't wait 30 days. Within that 30 days, whether it is next week or whether it is in the next 5 seconds, and you rebuy the security at $75, that is a wash sale. The consequence of a wash sale is that you are not allowed to offset your income with the losses. All you're doing is locking in your losses and you have none of the benefits. How did I do it to maintain my portfolio allocation while avoiding a wash sale? The first thing that I did was when I saw that the market was going down, I made a decision. Am I going to do this? If yes, when am I going to do this? I decided that I was going to wait for at least $3,000 in losses. I didn't know if it was going to go lower. I didn't know if it was going to go higher. I simply picked a number and I went with it. That number is not random. It should sound very familiar to you. The maximum that I can offset against my regular income according to the IRS rules. So once I saw $3,000 in losses and up, that was the time for me to get it done. I sold a low-cost S&P 500 index fund and I bought a low-cost total stock market index fund. The expense ratio for both of these funds is 0.03%. I was only out of the stock market for seconds while I set up the buy. All of the research that I did about whether or not I was going to do it, which funds I was going to use, whether or not they were considered to be substantially similar, whether or not it was going to largely maintain my asset allocation. I did all of that before hitting the sell button. And although I traded an S&P 500 fund for a total stock market fund, I largely maintained my same allocation. While the total stock market index fund has more stocks, the funds are market cap weighted. So the S&P 500 funds are so big, all the same companies that make up the top 500 of the total stock market, they actually collectively compose more than 80% of the total stock market index. I also made some other changes. I took that as an opportunity to sell some individual stocks that were not performing as well. They were in the red. I wanted to get rid of them, but those stocks also happened to be included in the new index. So even though I got rid of individual stocks and I used that money to buy a total stock market, I'm still holding them in a roundabout way because they are included in the new fund. The three funds were IBIO, which is a biopharmaceutical company, PLTR, Palantir Technology, which is a software company, and Clover, ticker CLOV, which is a healthcare company. They have performed horribly. I wanted to be rid of them, and this was the perfect opportunity to do that. You'll notice that I did not mention international. We do hold international, but we mostly hold them in our tax advantage retirement accounts. So no action was necessary because, as I mentioned already, tax loss harvesting does not work in tax advantage accounts. My expectation is that the losses will offset my regular income, and then some of it is going to be rolling over in the following tax year because I don't expect to sell anything with gains this year. Of course, anything can happen. There's still 6 months left in the year, but based on what I'm planning for myself, that's very unlikely to happen. All right, so now we can talk about the funds that I traded. Both funds are ETFs because I highly prefer them over mutual funds. I actually made a video on why I think ETFs are superior to mutual funds, and I will link it in the description box below. Take a moment and check that out so you can see why I don't like mutual funds as much. Both funds are also passively managed, hence the low expense ratios. All right, here's the original fund. That is the fund that I get rid of. It is the SPDR Portfolio S&P 500 ETF. The ticker for that one is SPLG. That is the fund by State Street Global Advisors, and State Street Global Advisors is a Boston-based investment manager. They are a division of State Street Corporation. That ETF tracks the total return performance of the S&P 500 index, and it holds 504 companies. The new fund that I acquired, iShares Core S&P Total US Stock Market ETF. The ticker for that is ITOT. That one is by BlackRock. I'm sure you've heard of them. It's a New York City-based investment manager, and it is the largest in the world. I think they have more than $10 trillion under management. This fund specifically tracks the total return performance of the S&P Total Market Index Fund, and it holds 3,638 companies. A fun little fact about this fund is that it actually started tracking the total market only in 2015. From the time the fund was created in 2004, it only tracked the S&P 1500. That is why if you check the performance since inception against the total stock market index, it is not perfect because for a while it was only tracking the S&P 1500. But if you look at the more recent years, 2015 and later, it is nearly identical, and the beta is almost at 1. And if you don't know, the S&P 1500 includes all of the stocks in the S&P 500, the S&P 400, and the S&P 600. Now let's do some performance comparisons. We're going to compare the S&P 500 fund versus the total stock market fund versus the S&P 1500 fund. If you invested $10,000 over the last 10 plus years, or even over the last 20 years, you will see that performance is actually very similar. As of the most recent market close, you would notice that the S&P 500 would be up $773 compared to the total stock market fund, and the S&P 500 would be up merely $140 compared to the S&P 1500. That is a very marginal difference, and that is the price that you pay for diversification. In all three situations, you would end up with more than $40,000. You would quadruple your money in that time if you had invested $10,000 in either of these funds. And finally, we are in the home stretch. I promised, so I'm gonna deliver. Here are some funds that are similar but not substantially identical that would run afoul of the wash sale rule. These are funds that I track for myself that I think are okay. This is not advice. You evidently have to do your own research. If the IRS comes after you, please do not tell them that I told you to do this. But if we are going to do total stock market funds, we can look at VTI, which is the Vanguard Total Stock Market Index ETF. We can look at ITOT, which is the BlackRock Total Stock Market ETF, or we can look at SPTM. That one is not a perfect match. It's actually the S&P 500 index fund from State Street. So it's only 1,500 funds, not necessarily the 3,000 or 4,000. But because there's so much overlap, even though it is not a perfect match, it is close enough to give you the desired returns without running afoul. In my personal opinion, all three of these funds are interchangeable. I would be very comfortable swapping one for the other in a tax loss harvesting situation. When it comes to the S&P 500, I would be comfortable swapping out SPLG for VOO or for IVV. SPLG is the State Street S&P 500 ETF, VOO is the Vanguard S&P 500 ETF, and IVV is the iShares or BlackRock version of it. If you are into mutual funds, that's not my jam, but I want to offer something for everybody. Total Stock Market Index Mutual Fund, SWTSX, that is the Schwab version, VTSAX, that is the Vanguard version, and FKSAX, that is the Fidelity version. You might also be willing to do FZROX, that is a personal choice. The 0% expense ratio is certainly nice, but you may not necessarily get the exact same performance because there are some pretty big differences there in the amount of stocks that they hold. Also remember that if you decide to swap out mutual funds for mutual funds, you might put yourself in a position where you could potentially incur commission charges when you're trading a mutual fund with a broker that is not necessarily the fund manager. You'll notice that I gave you ETFs that match ETFs and mutual funds that match mutual funds. I want to be very clear that personally, I would not change an ETF for a mutual fund or vice versa if they are both of the same fund manager. I would not do a Vanguard to Vanguard swap between an ETF and a mutual fund because I am highly skeptical that this would fly with the IRS. That means I would not do VTI versus VTSAX. I think that is potentially a recipe for trouble and for getting hit with a wash sale violation and having your losses not count for anything. If I was doing an ETF for mutual fund, I would go with a completely different fund manager if I was doing the swap with a different financial vehicle of the same index. If it tracks the same index, I am not doing it. For example, I would do VOO against VTI because even though they are the same fund manager, they track different indexes, but I would not do VTI and VTSAX. But you're grown, you can do whatever you want. That's just my personal preference. It doesn't guarantee necessarily that there's going to be a problem, but personally, I like to do everything that I can to put as much distance between the two securities as I can. All right, so here are some sources and additional information if you want to check them out. Thank you for sticking around, and as always, I have some questions for you. Have you heard of tax loss harvesting? If you have you taken advantage of it? If you haven't heard of it before, is there anything in this video that makes you feel like you might be interested in finding out more and employing this strategy for yourself? Leave me your response in the comment section below, or feel free to make a video response. I hope you enjoyed the video, and I will see you in the next one.
I would like to continue sharing my thoughts on all things money with you. So I would appreciate it if you could help out the channel by liking this video and sharing it with anyone you think might benefit from it. If you want to see more content, be sure to subscribe and hit that notification bell so you can know when new videos come out. I'll see you in the next one.